Hey, welcome back, Accounting 604. It's video number 3. And in this particular lecture, we are continuing in our journey in Module 4, our initial look at how to analyze financial statements. And in this deck, as you can see from the title, we are looking at Disaggregating Return on Assets. We were looking at, in the previous lecture, disaggregating return on equity, applying the classic DuPont disaggregation formula. And now we turn our attention to return on assets. And you can see here what we're really looking at in this deck is a closer look at what we've already sort of at least quickly described, and that is that return on assets can be immediately disaggregated into profit margin and asset turnover. And you see here that essentially, while the mathematical fractions to figure those two things out, net income divided by sales and sales divided by average total assets respectively, should be reviewed for us by now. Really what we are saying is that operational managers actually can have a hand in increasing return on assets for the enterprise, either by increasing profitability for a given level of assets or by reducing that level of assets while still generating the same profit level. And of course, if you're able sort of to do both, right, the classic managerial demand of making more from less, increasing profit while also reducing the overall level of assets, then you are really impacting a return on assets. And then depending on the level of financial leverage, you're also probably affecting ROE as well. This adjusted ROA business insight, which is an excerpt from the textbook, is worth going over in detail and really digesting. And essentially what it is saying is, as we have alluded to before in previous slide decks, there are some elements under the control of the direct control of operating managers who have an opportunity to influence and improve. And of course, there are other elements that affect a company's performance, overall economic performance, which are out of those hands, including capital structure, with the relative proportion of debt to equity, as well as the tax burden. And so you can see here the adjusted ROA that we oftentimes will look at attempts to offset or adjust computed ROA for the sake of interest expense and typically the statutory tax rate, in this case assumed to be 22% federal and state, in order to give a clearer insight into the factors that are really under control of operating management. We can continue to go forward then as we look at here, as we've mentioned before, the first level, and this is from the previous slide deck, the first level of disaggregating ROE is the DuPont disaggregation of ROA and financial leverage and significant NCIR if there is one, right? But now in the second level, in this deck, really what we're focusing on are the factors that drive real profitability and productivity. In other words, the factors that really do seek to affect ROA. And as we've mentioned, that would be the profit margin and productivity or asset turnover. But for the sake of analysis, this slide attempts to break down or disaggregate the potential for both profitability and productivity into finer gradation. As you can see here, profitability can really be affected by a few different factors here. Gross profit margin, operating expense margin, both of those can be influenced by operational management. And then productivity gives you some gradations as well, as you can see there in sort of the right-hand side under the purple productivity, which is primarily manipulation of the cash conversion cycle or improvements you can make there, as well as perhaps long-term PP&E turnover. So that's really what we're looking at in the next couple of slides. So when we stick to the profitability side, here's one thing that we might be able to adjust or influence. Both the selling price of a company's products and the cost to make or to purchase the raw inputs for those products All right, both of those will affect gross profit. Obviously, the higher gross profit that you can accomplish, given your position in the marketplace and the products and services that you are offering to the marketplace to buyers, right? Generally, the higher the better. And of course, if over time gross profit margin is dropping or is uniformly low, well, then we have some concerns, some other things to look at. As competitive intensity increased, has the product line gotten stale and lost appeal? Have product costs increased, perhaps because vendors need to be refreshed, or maybe there are external factors like, for instance, global tariffs imposed that weren't there previously? Is there a reason to consider perhaps you need to refresh your product mix overall? Or perhaps is volume declining while our fixed costs or underlying fixed costs have remained the static and the same? All of those are potential avenues to explore, and of course each of those, if you are able to manage, control, and improve them, may provide a shot in the arm towards your actual gross profit. Now, before we leave this slide to continue looking at other factors that affect profitability, think about that for a moment. These are the kinds of items that quietly behind the scenes, the long perspective on management will attempt to really understand in fine detail what is going on, where is the company, and what is the company really sort of settled on in terms of the cost of production, and is there a way to shake those things up for the sake of benefiting, eventually, return on assets? And continuing to look at this, okay, those are the things we looked at there were essentially the inputs into our product itself, or sometimes you might look at that as simply, is there a way to optimize cost of goods sold? Whereas this slide is talking about, well, those aren't the only level of expenses, right? SG&A, right? General operating costs, of course, those typically get spread across every sales dollar in figuring out and calculating the operating expense margin. You can see the calculation there at the top of the slide, SG&A divided by sales, right? What are you spending for every dollar of sales in other types of operating expenses besides the cost of the product or service itself? And here is where, as we've talked about in the last lecture, perhaps really management needs to turn a fine microscope upon every dollar and cent of operating expense to see whether or not we can really optimize this to improve profitability and therefore overall return on assets. Now, when we turn our attention away from profitability on to productivity, really one of the first things we're looking at is productivity reflected in asset turnover. Reminder, the basic calculation is your level of sales revenue divided by the average level of total assets. Again, just as a point of review, you take the level of total assets at the beginning of the period, add them to the assets at the end of the period, and divide by 2 to reach a mathematical average, right? Well, really what we're talking about then is, when we talk about asset turnover, is your cash conversion cycle. You're really looking at how quickly can you convert cash into inventory, inventory into sales, those sales into cash, and relative to when you have to pay your vendors for the inputs or the resources that you purchased on credit. Now, we've looked at this in a previous module, just an example. If you remember, Apple's cash conversion cycle versus, at that time, we were looking at Applied Materials. And really, so what we really need to refresh our heads on is the cash conversion cycle typically begins with, once you have allocated capital to operations, the first thing you're doing is buying inventory, or the inputs to inventory, right? On credit, typically, and that becomes an account payable, right? And then you are selling your inventories, oftentimes also on credit, which then becomes an accounts receivable. Then, somewhere along the way, you are hoping to collect your receivables sooner rather than later, and eventually you've got to pay your vendors. You have to pay your accounts payable, and of course, from your perspective, you would like to pay those as late as possible and not, tick off your vendors, right? Or worse, go into default with them. Okay, so generally, a company will do better with a lower, a smaller, a shorter cash conversion cycle, because what does that imply? It implies that your operating cycle is generating profit and cash quicker rather than slower. All right. So our analysis of each of these measures focuses on trends over time. And you may look at that within the same company. Are you, as a company, doing better or worse than in the historical past? Or how do you compare versus other competitors in the same industry, perhaps even in your marketplace? We've mentioned before that all of these kinds of things can differ significantly based on the industry and, of course, based on the company size. Here, this slide just simply attempts to remind you of that in some industries, the cash conversion cycle can be significantly long, as you see there in healthcare and industrials, whereas in others, they can be alarmingly short. You see there at the nearer the point of access there, energy and communication. Now, here, I don't think we've looked at Pfizer, our example company for Module 4 before, and you can sort of see here the 4 bars here, right? The inventory outstanding bar of 96 days, which essentially means that Pfizer holds raw materials, work in process, and finished goods generally for about 96 days until they're able to realize a sale on average of that product. Then you see that DSO of 41 days. What does that mean? It means when it's sold, how long on average does it take for that sale to remain outstanding until you can collect your receivable? And in this case, it's about 41 days. Days payable outstanding, that I guess that beige looking rectangle on the left, illustrates that generally speaking, on average, Pfizer's suppliers, the vendors they purchase inventory from, will on average allow about 66 days before the payable needs to be paid in cash. And then what you see there is the cash conversion cycle. In other words, once you total all this up and adjust for it and do the math, Pfizer's cash is typically, on average, tied up in inventories and receivables for 71 days, which means that's got to be financed. Okay? Now, a positive cash conversion cycle, that's kind of the norm for most firms, far and away. And of course, you realize the one example we gave you in the previous module is Apple, which has a negative cash conversion cycle. They can actually start investing the cash before it's due to be paid out to the vendors. And so by comparison, just as a reminder, you see here, right, days inventory outstanding, a short 25 days in inventory before it's sold. Typically, it's actually pre-sold and shipped when it's manufactured. A very quick collection of sales. The time between sales being made and when the cash is collected is only 9 days, which is, ridiculously less than 2 weeks, right? And an extremely long time to pay the suppliers of 97 days. What does it all mean when you do the math? It means that the cash conversion cycle is actually negative for Apple, which is very, very rare, and it means that Apple can invest the cash it receives from product sales for 63 full days before they need to pay their suppliers. And what this really means is that this cash conversion cycle is so well managed through a variety of factors, including perhaps brute force and bullying your suppliers, as well as leaning on your customers for pre-sales. It's so well managed, this is actually a durable competitive advantage that takes the heat off your finance department. Strategically, management has managed the cash conversion cycle to ultimately affect productivity to the point this is, again, a sustainable competitive advantage. Now, all that being said, as we look at Pfizer, remember we said not only can we compare cash conversion cycles from one company to another, but within the same company over time. And you can see here, from 2021 to 2022, they actually improved the cash conversion cycle by about 16 days. And you can see there that about half of that improvement is simply by extending their payables. In other words, it delayed paying its suppliers by about a week, while it improved its sale of inventories, as well as a little bit of an improvement in collecting receivables after sale. But all of this means that there's a small, right, about a 2-week, little over 2-week improvement or shortening of the cash conversion cycle. But because Pfizer is such a large company, that means that there is millions of dollars in savings impacted from a financial perspective because of, well, a scant 2 weeks in savings in the cash conversion cycle. The moral of the story here is that even small improvements in some factors can make significant, durable improvements to overall productivity and therefore return on assets. Finally, we reach the analysis of the long-term stuff. Well, what about your PP&E, right? What about the large-scale production equipment, the long-lasting depreciated assets that continue to do the hard work, if you will, the heavy lifting in production of your products and services? It isn't easy to improve PP&E turnover because it isn't easy to lower the denominator in this particular fraction. As you see it, sales divided by average PP&E. PP&E is long-term durable stuff, and so it isn't easy to change over your production line, right? As you can see here, some of the things that it entails might be divesting yourself of unproductive assets, which may have implications for entire business lines. It may mean entering into joint ventures to jointly spread the use of your PP&E assets with other subsidiaries or other types of entities. It may mean divesting yourself of production facilities, which means you got to get your stuff from somewhere. So maybe it means you have to balance that with how you're going to purchase finished goods from some other facilities owners, right? All of these kinds of things, right? Maybe you have to divest yourself of that really expensive, flashy headquarters you built and lease it back financially in order to lower your average PP&E. But as you can see, each of those are non-inconsequential, non-trivial types of considerations in order to, over time, improve your productivity by lowering your PP&E foundation. Now, another consideration here is, as we've talked about a little bit in the previous slide deck, what about financial leverage? Is there a way to improve ROE at any level of ROA by optimizing our use of leverage? And it bears reminding us why leverage in the first place. Yes, certainly it amplifies the outcome of a deal. Why is that? Because it provides capital without increasing the level of equity, obviously. It also means that, generally speaking, obtaining capital through borrowing is less expensive as a source of capital than the average cost of acquiring the capital through the sale of equity. That is, by the way, the domain of a finance class that you will take. If you haven't taken it already in this program, you will take a corporate finance class that will address that whole topic of the weighted average cost of capital. But for now, let us simply say that in most cases, borrowing money is less expensive to the enterprise. That's one of the reasons that makes it attractive. But of course, borrowing adds risk, as we've talked about extensively in the previous deck. And so when you analyze the level of financial leverage that's revealed in a financial statement, then part of that becomes balancing out and trying to figure out what is the balance of the level of borrowed money relative to equity, and what is the cash flow or the level of profit that's required to make those debt payments without putting yourself on the hot seat, right? So you can see there, total liabilities to equity, pretty easy to figure out, right? Total liabilities divided by total equity. And one of the things that is, you can see there, of great interest to companies when companies have embraced a fair level of debt is what's times interest earned, or TIE. What level of earnings before interest and taxes do you need to make in order to make your interest expense, your gross interest expense, on a regular basis? Now that brings up one other interesting and perhaps a little bit of a fancy consideration when we start talking about the financial leverage picture and its impact on ROE. And that is the impact of stock buybacks to reduce the level of equity, and in some senses to artificially inflate return on equity. Specifically, what are we talking about? Before you dive deep into this little business insight from the textbook, just think about that numerically. If ROE takes net income in the numerator and divides it by the average level of equity in the denominator, then lowering the number on the bottom of that fraction, which means reducing the level of equity, is automatically, mathematically, going to greatly increase your return on equity. That's just the way that basic arithmetic works. Well, one of the ways that you can manipulate the level of equity outstanding is to buy back your stock. And now, if you go and take a look at sort of the middle of this business insight, it asks you to consider what Apple has done from 2018 to 2022. During that time, Apple's total net income was about $370 billion, but its stock buyback totaled over $400 billion. In other words, they were plowing more than just net income to simply buy back stock, and as a result, it really reduced the amount of outstanding stockholders' equity from over $100 billion to half of that. Why would you do that? Why would you spend your hard-earned profitability, your profit, to buy back stock? Well, you see there in the last sentence, the effect was to increase ROE, which of course analysts and investors are using as a way to evaluate Apple stock. ROE jumped from 49%, which is already pretty significant and eye-opening, to an eye-watering 176%. That's what happens when you use real stock buyback power to, at least temporarily, increase return on equity. What does that mean? Well, if you are analyzing a set of financial statements and you notice that aggressive stock buybacks is, in some senses, artificially inflating return on equity, well, you know what? Probably return on assets is a more accurate picture or window into what is actually going on at the company, because the great increases in ROE have been, well, they've been secured or accomplished through financial leverage manipulation. What are then some insights that we might take away from this? Well, there's a couple things that you should note. One, profitability and productivity are really sort of a trade-off as you consider, how do I improve my company's performance, or how might I suggest that management think about improving the focus here. And of course, this harkens back to the age-old strategic tension. Do we, like a luxury brand, say Rolex or Hermes, right? Do we chase after very high margins with luxury goods and simply accept that the turnover is going to be slower, it's going to take longer, right? Or do we approach life more along the lines of a Walmart or Costco, which is we are going to try to approach return on assets through very high turnover, but thinner margins for each unit sold. So that's one consideration that is revealed as you begin to really examine what are the drivers of profitability and what are the drivers of productivity. The second thing we will remind you from this deck is clearly cash conversion cycle. If you can really get a handle on managing the days that each of those items are outstanding, can be an actual durable strategic advantage. And you saw, even in Pfizer's case, just reducing your cash conversion cycle 16 days was millions of dollars back in the kitty, right? That can be used for other purposes other than having to essentially finance your cash conversion cycle. And then finally, in this last set of slides, what we're looking at is the very real impact of manipulating your stock outstanding on ROE, and why then, if you observe that kind of thing in your analysis, ROA is perhaps really your home base. I hope this has been useful. More of this in the textbook as well. The textbook publisher provided lectures, and of course you will have a chance to work all these things out in your homework as well. We will see you in the next video.